Unlike any other traditional family office where we invest across asset classes. So I do this with my dad and my brother. And so we invest in everything from a government bond and a fixed deposit to an angel investment and everything in between. I think each person has to figure out their risk appetite, and we went through a scientific process after we sold Dr. Vedya's to then say, hey, we need to now start structuring our investments. And we went through a scientific process to understand our risk appetite and then do a sort of portfolio allocation across asset classes to diversify risk. I actually met Saurabh through a friend, and I thought his background was absolutely fantastic. And then he told me about what he was building. As risky as your risk appetite will be, you will still want to invest in fixed income instruments. It may be 20%, 30%, 50% for us as a family in fixed income instruments. And there was no platform, no product that talked to you as a new age consumer about this. And so as a lot would be built in equity, there would be some companies coming up in the fixed income space. And I think the way Saurabh is approaching the problem is a very interesting one. It's a product I would use. People should understand what they're investing in and why they're investing. And I think platforms like these can actually democratize learning and make people take better decisions. And like we did with Ayurveda, we repackaged and rebranded to appeal to a modern consumer. I hope Stable Money can do the same.
The problem with preferred advisors and stuff like that, they're offered to only maybe 2% of the population. But the vast majority of middle class is basically doing it of their own free will and doing all sorts of weird things. When I did a straw poll amongst my youngsters in QMath and asked them how many of you have put money in these new age companies that have IPO'd, 85% of them raised their hands. I was like, okay, that's pretty cool, just a data set. And then I said, how many of you made money on it? 5 out of 85 kept their hands up. These are not people who are super rich, they're middle class, right? And they're young, which means they don't even have too many assets built up. They've taken their hard-earned money and put money into an IPO because they got, done in by the marketing. So I said, with all the amazing IQ that was in front of me, they're obviously very smart boys and girls, you've lost money. And I said, even if you had put it in an index fund as a punt to say, I don't care, you would have made more money, like the portfolio would have been better. So I do feel that if Stable Money is going to take either that cohort or the cohort up just above that, there is a space for what is called democratizing advice.
One thing which I read about later on, which has actually helped me correct it, is something called the barbell strategy. This is Nicholas Nassim Taleb. He wrote the book on anti-fragility, and he talks about this, where your investment should be like a barbell. Like one end of the barbell you have what is very basic, simple, passive investments that can give you as much as possible guaranteed return, and that should be where maybe majority of your money should be. And on the other end, maybe like 10% of your money you should keep in this form of investments which will give you asymmetric returns. So 90% safe and steady, 10% in asymmetric returns where you have a chance of maybe doubling, tripling, 10xing your money. I think this is one of those things where I feel it's so important for every individual, especially people who are starting out young, to have a very strong awareness about money management. That you can't only depend upon a job to be able to assume that you have salary. You have to have a parallel income stream. And so for me, I think something like Stable Money is all about that. It's about saying, if you are making good money in your salary, you should try to take some of that money and try to create something that is working for you. Because while you are working so hard for your money, it's also time for the money to work hard for you. And I just believe that India is in a place where it's such a young country. 50% of our population is less than 28. The next 10 years, I believe, are going to be India's time in terms of growth, economic prosperity. So this population will become even more wealthy. But I feel it's super important for this entire generation to make sure that they are keeping some of their money aside, so that in the future, if there is ever a downturn, if there is ever a maybe a tough period, they'll have enough income to be able to go through it. So something like Stable Money from a thesis perspective is something which attracted me. The combination of great founder with a thesis that I believed in is something which I felt is perfect here. I think everybody in fact should be also educated more about money management right from college, so that when they go out, they are all looking for products like Stable Money, and they're making sure that they are keeping their money safe and also letting it grow in a nice and maybe more low risk manner.
There are a lot of distributors and so on, but retail really does not have exposure to the right kind of asset classes within fixed income, the right deals, let me put it. The idea is very compelling. I think the market opportunity is also right, because I do see a lot of tailwinds. In fact, with the regulators, I've worked a lot with our regulators, and they have to be supportive of what you want to do. I think the additional piece of cake which is really missing everywhere is being transparent and in a way ensuring that what you are selling is the right thing for the investor, because that knowledge is limited to few in the industry, and something like a stable money, once it scales, you will have far more access to knowledge than someone who is a retail investor who will not understand that what is the difference between a AAA and a AA, right? For them it's just one A away, right? So yeah, I think that transparency and bringing that sort of faith that you are doing absolutely what is right for the customer is what I really hope stable money would bring.
My portfolio, of course, today has a lot of risky investments, but it's built on the back of some stable cash flows. So it's very important to build that stable income or that stable financial foundation on which then you can do. It then allows you to then play a larger game with the mindset that the stable is taken care of. When I first heard the concept of stable money, I think I could see how that is an important part of my overall investment philosophy going forward, right? Where you have some risky investments that you've taken either on the angel investment side, some on the equity public market side, some on the more risky debt side. And it was important for any individual to start also having a part of your portfolio in a stable instrument which can give you that cash flow, which can give you that foundation and allow you to be more aggressive. A customer of our generation who's now looking to let their capital work for themselves and to generate returns of their capital, there was nothing that sort of spoke to them in their language. And I think that was refreshing to see when we first spoke about the idea of stable money.
I think for me, Saurabh being the guy, along with Harish, right, being the people, Saurabh and Harish being the people who are tasked with tapping into this opportunity was a very big reason, probably 90% of the reason why I actually said, no, I'm willing to take a bet on this company with my own money, right? And I'm fairly sure that there are the makings of a team that can achieve that. What I would love to see is a team that goes on to create a company that is truly seen as a breakout company. I'm very sure that there is a team in the making here, and you guys have a great shot at it, I feel.
I am super new to whole angel investing, right? I do not understand how companies are valued, I'll be very honest. I do not understand how to value some idea. I don't think I have the skill set or the specific knowledge that is required, which a lot of great people in the ecosystem have, right? What I do understand though is I can spot a great operator when I work with one, right? So for example, with stable money, right? Saurabh came to GrowthX as a member, right? And I saw Saurabh on the kind of questions he's asking, the way he interacts, the way he treats people, the pedigree he brings and the humbleness he brings to the room, right? And I think that is critical when you invest in a company. I would essentially take a very long bet on India and Indian founders, right? So I only invested in Indian founders. I've only invested in people who I have closely seen being an amazing operator, right? Like all my founder investments are either ex-cred, people who are GrowthX members, founders that I have genuinely helped or worked really close with. I don't invest saying, okay, because you are at some pedigree, I'll invest. No, until I've seen you as a core operator, because I think that's a core thing that you need when you are a seed stage founder. That are you like gonna roll your sleeves up and actually gonna do stuff, right? Or are you gonna just sit and hire a chief of staff when you're a seed stage, right? That's the last thing I want when I am thinking of my investments, especially in startups.
Eventually, a decade from now, I hope stable is that one platform that would take care of all my investments, right? I do not want to manage money across multiple different platforms. I think it's a great starting point, and eventually I hope that, and especially like seeing these early designs, seeing some of the early team that's come together, I think it just increases my confidence 10x, right? I think I'm very excited to see the first launch coming through, and from there, if I were to think a decade from now, I think, as stably as my money can grow, I think that's where I'd want stable money to be.
Ladies and gentlemen, a very good morning to you. For those of us joining online, we request you to wait for 5 to 10 minutes as we allow for the participants to settle in. We'll begin the event shortly.
After opening the app, the first thing which actually caught my attention was the fact that you were providing like up to 8, or I think close to 8.85 or 9% returns, right? So that was something very lucrative for me, and so yeah, I just thought probably I should at least like go through the app once and probably try. Company being so transparent and showing us other options as well outside their scope, which they haven't collaborated with, probably banks and NBFCs, which are not yet onboarded. So, I mean, displaying such options for me and to provide me with that sort of analysis and benchmarks to actually figure out where I'd want to invest is actually a great move. So I really appreciate that. So I think for a user who is probably new or already, somewhat has been exposed to this asset class, it pretty much makes sense because you would not know otherwise what the FD returns are going in the market, right? So this feature being within the app itself provides, like, I think, or gives a good sense of like the benchmarks and standards which are out there. Yeah. I think since I've been using some apps again, so I think compared to that it was pretty seamless and pretty smooth in a sense because I had to just submit my PAN card and give my like Aadhaar number and verify it, and that was all that it needed to probably get me started. So yeah, it was pretty smooth. Otherwise, I know while opening my first FD, I had to like open a bank account first and then invest. So yeah, that way it was pretty seamless for me. Yeah. I think a lot of people are under the same assumption that FDs have not been giving the returns probably. Making all of this experience pretty smooth and again seamless. So yeah.
I'll not think about Bajaj Finance Limited or any of the NBFCs to be precise, but when I went through your application, it was all in front of me. So I was glad to see that these banks are giving 2-3% higher rates than the renowned banks. I do have an option whether I want to invest it for 1 year, 3 years and 5 years. But herein, which FD is giving best interest rate depending upon the tenure which I am looking to invest is the best thing I was able to find via your find feature. So this was the best thing. I was able to compare the bank which I thought of and the bank which I changed my mind after visiting your application. So does my risk factor increase to what level, until what level RBI is securing that? In some of its, in some banks it's 5 lakhs, 10 lakhs. So I can invest my amount accordingly. So it is really easy to book an FD, and the best part is you don't even need a bank account to book a FD in this. So there was something new that I was able to find out, and booking process is so easy. You just have to submit your basic document, 1 or 2 documents, and it's almost done.
Information about FDs and stuff is like super cluttered. What was good about stable money is that, like, and I was just telling this to like outside as well, that hey, it allowed me within the app to sort of compare all FDs, right? So usually what happens is, like, for instance, if I'm like using HDFC or if I'm using like any other, like whatever, my net banking to invest FDs, I will only be able to like largely see whatever's available on their platforms, right? Like I can't really necessarily like compare all available FDs within the same net banking space. So that was great that like, hey, I could use like sort of Stable Money, the app, to come and see like all possibilities that I can invest in, regardless of whether or not I can invest on it on Stable Money's platform, right? So that was helpful. It did like collect all the information for me in one place, and otherwise, like as soon as you log into the app, like just the fact that hey, you can see like what are the top 4 FDs that have the highest interest rates that I can invest in, right? That was also super helpful. Like just like having that information right in front, right? Yes, 100%. Like I totally see myself like sort of using that, right? Because my goals necessarily aren't always like getting the highest interest rate, right? Like I also want to, let's say, invest in different tenure sort of investments for different reasons. So that way, like I think what was available to me from a Find My FD was super helpful. I would 100% use that.
First time I saw something like for FDs. Actually, there are many other apps in the market for mutual fund, for stocks and everything. But first time there is a unique feature in which you can select FD and which would give like better interest rates, and so you can select as and per your requirement, and it's very safe and useful. So
I think one of the primary things that that really stood out for me was having the app tell me what I could invest in, like comparing between the different options and maybe just shortlisting like a couple of them. Also, the very fact that gender played a role, I didn't know that. To begin with, I actually didn't know that you could create like an FD in an account that I don't have, like in a bank that I don't have an account in. When you think of FDs, you're thinking of so many banks you have, there's just too much of choice. And you don't really know which one to choose. That's like, I think that's the biggest thing. And if you don't have a financial consultant to do it for you, you're just going to be lost. So having this option, like giving you so much information about each one of these banks and saying that, hey, listen, you can, and the different tenures that are available, which there are like so many. Like I didn't know that you could invest something which for as short as maybe a year and a half, or maybe under 3 years. Like when I think of an FD, I always think of something which is like, you know, you're sunk, like it's sunk for a very, very long time. It's a very smart way of like giving the power back to the user, because you're saying that, hey, it's not just like you get to choose, like you have agency in your choice, you're getting so many different things to vet before you actually make that choice. If I have like a set duration in mind, I can still choose from so many, as opposed to saying that it's sort of, you're forced into putting only in like a few options which are made available to you. This whole journey of actually even getting into the understanding why fixed deposit, like what fixed deposit could be, like a couple of years down the line. I think that information has also really helped. For sure, I definitely think that it's making this whole process very smooth, because it's like under 5 minutes. I think I can choose which bank I want to like invest in, and yeah, and actually finish that investment, to finish that whole thing like in under 5 minutes. That's pretty cool. Like it's very fast. I think that's like an added bonus to this.
Thank you all for joining us today. We're thrilled to have you here. I'm Ruchika, someone fortunate enough to have been a part of Stable Money's journey from the early days, and I'll be your host this morning. Stable Money opened for early access on August 8th, and since then we've received an overwhelming amount of love and support from our customers and partners alike. Being here today feels a little surreal. There was no way we could have anticipated this. So why are we here? If you know anything about us, you know that even as we take pride in being a fintech platform of tomorrow, we're deeply rooted in tradition. Whether it's about launching with fixed deposits or insisting we meet some of you offline today, we believe in doing things a little differently. We're gathered here today to witness the launch of the platform, and as we unveil Stable Money, we'll also be delving into not one, but two enlightening panel discussions. Of course, I could go on and on about Stable Money, but allow me to introduce someone to you who's at the heart and center of the organization. Saurabh, I request you to please come on the stage and take this forward.
Thanks, Ruchika. Ruchika slipped at 3, was solving for customer queries. So thank you so much for doing this. I think there was another big gathering a couple of weeks back in Bombay around GFF, and everybody spoke about fintech and how fintech is changing the way India is looking at financial technologies. Last decade was really important for us, but the next decade is even more important. So I think we have created a video which talks about Indian stories in our context, right? So maybe we can start that video first.
The Indian growth story is second to none. Our country has grown at an average of 6.15% in the last decade and is set to grow at a rate of 6.70% in the next decade, opening up a world of economic possibilities. But what contributed significantly to India's growth story was the digital boom. 86 crore Indians have access to the internet, and in 2022, we recorded 28 billion app downloads. Apps that could track cattle, apps that could deliver grocery, apps that could help you find a potential partner, and apps that could help you invest lakhs of money in just a few minutes. Yes, just a few minutes. The last 10 years belonged to financial technology. 46% of all digital payments happen in India, and 93% millennial investors invest digitally. But one industry remains untouched. India has 11 lakh crore invested in fixed deposits, which means 1/3 of all investments done in India are in FDs. Then why shouldn't there be a product that brings FDs to your fingertips? India's story has just begun. Tomorrow is ours. Let's make it count.
Cool, thank you so much. 110 lakh crores in FD, 12 crore retail investor. I believe this is, I've been getting messages that this is one launch that people are seeing with their parents also, because they're very happy that we are talking about FDs today. But let me start with stable money and what has happened in the last 1 month. We actually launched on 8th of August, and the plan was to do launch for our waitlist users, run it for a couple of months, and then scale it to everybody. But thanks for the overwhelming response. Some of the customers have come here personally. And because of you and the people who are seeing it on the YouTube, because of you, we are off to a really, really great start. And we thought we'll do this sooner than later. And that's why today we are here. I know the expectations are not very high after yesterday's Apple event, but I'll quickly talk about when we started stable money. It's actually started 10, 11 months back when Harish and I were discussing that we want to do something in this fintech space and talk about the retail customers. I think one thing that I have observed during my time at Navi Mutual Fund is that everybody has a very different approach when it comes to investments. And if you look it from the outside, you'll see that some of these approaches are really crazy. But to be very honest, I think everybody has, everybody takes investments really seriously. But the problem is, despite multiple approaches that we take, they don't have peace of mind, right? So, and a lot of people are constantly chasing new trends, getting into the FOMO, taking a very risky short-term bets. I think we want to change this at Stable Money. We want to build a habit of compounding-led investments through our platform. We are focused on fixed return products because that's a very significant part of retail customers' investment. And this grows irrespective of the market condition, like a money plant, right? So that's what we are focused on. We want to, you don't have to worry about beating the market. At Stable Money, we want to, we don't want you to compete with the market. We want to introduce products which will have a positive growth irrespective of how the market is performing. So that's our goal. So when we started with this thought, the most important time that we have spent is on figuring out which is the first product to launch, right? And we have multiple other options than FD, which is debt mutual funds, bonds, sovereign gold bonds, and multiple such products. But we said we want to start with FDs because this is India's favorite asset class that requires the innovation, right? That has not significantly changed over the last few years as the UPI has came, as the stock market investing has come, as the mutual fund investing has come. FD has still not changed the way it used to happen. People are still doing it a little traditional way, though I have one very interesting number to talk about that in the last 1 year, 1 out of every 4 FDs getting booked on net banking. That also means 3 FDs are still getting booked when you have to go physically to the bank and do the FD investments. When we talk to customers, they think that FD doesn't beat inflation, 5 se 6 taka milta hai. There are a lot of such misconceptions are there when retail investors are thinking about investments. So we said that this requires the change. And though people think it's a traditional way of doing things, we feel this is a very bold approach for stable money to take. Because I think one thing that we realize is if we are building it for India, we'll have to understand the habit. And we realize that though it is not top of the mind investments for a lot of customers, everybody still has a significant portion of their investment in FD. So that's why we chose FD as a first product to go. And we are here to change how people do FD investments and fixed return investments in India. The most important thing that we have also realized is in India, any successful company that you have seen, you have to be relevant for the masses. And if you have to be relevant for the masses, you have to be very simple, right? It can't be very complicated product. And we were very clear that from day one, we want to build it for masses. We want to build it for few million customers in India. And the most important thing was how do we make the entire product, the design of the product, so simple that booking an FD is as easy as doing a UPI payment for the users. And we have some numbers to talk about that, but these are some of the screens that most of you must have seen onto our app, in which we have around 200 plus banks where you can easily see the rates across these banks. You can compare the FDs. You can find what is the best FD for you. But there are some very interesting numbers that we are talking for the first time in the last 1 month to the larger audience. That 70% of the FD bookings that are happening today on our platform is happening on the first app session. That means people are downloading the Stable Money app, and when they go onto the platform for the first time, 70% of the customers are doing the investments. And that is very interesting for us because when it comes to FD investments, the most important thing that we realize is it's a hard-earned money that people keep in FD, that they want a positive growth. They don't want that money to go have impact, negative impact, right? So trust is the most important thing. Another thing that we have seen is 85% of the users are booking their FD in just 2.7 minutes, right? We were initially very surprised seeing that because we thought that FD is an investment that I have personally seen. My mom is on the video where I remember it used to be a long discussion where our family, my parents used to sit and put down all the FD interest rates across the different banks and took a couple of weeks to decide where to put in money. And now when it is happening in 2.7 minutes, when I actually showed it to her, she was very surprised that do people actually do that. But in this world of Zomato, Swiggy, Uber, Ola, right, we thought that that's the bare minimum expectations that a lot of customers have, that it has to be very simple. If the stock market investing is so simple, if the mutual fund investments is so simple, it has to be, FD investment should not be behind that. Yeah, so I think this is one thing that I very strongly feel, that building tech is very hard, but building trust is even harder. And why this is important for us, and some of the numbers that I'll talk, is almost 100% of the users that we have got so far, right? We have 50,000 plus users onto our platform. All users have come through word of mouth. All users have come looking at Stable Money, what we have said onto multiple social media platforms, what we have said in the media. And these people have trusted us. These people have trusted our partners and come onto our platform and build this. One very important thing, which is a lot of people told us on the app, if you go and see, our customer support still has a very traditional way of calling us if you need any help. And we feel that this is very important, specifically in the early stages, because we want to really understand how customers are thinking about FD investments. And what we have done is we have our entire team right now. The problem that we are facing right now, the scale at which we are growing, we are not able to scale our teams. I think this is a good problem to solve. But still, we have first response time as 300 seconds, right? And I really wanted to read some of the customer feedback for you guys. Just one second. And this is what exactly customers have mentioned. So Abhinav has mentioned that happy for your prompt response. It's late, go and sleep. Another Yugal has mentioned that thank you for your assistance. Hats off to you guys for providing solution to the problem in such a short time. I wish the best for your company. Your company will become as popular as Cred. Saurabh Srivastava has mentioned that thanks for the information. Congratulations on the launch. These questions were simply mean to get some clarification, not to discourage you. You are replying at 1 a.m. night. This is yesterday. Ruchika was doing this. I understand the grind and appreciate the work you guys are putting in. So I think this is what we are doing. I know there are cases where we must have missed out on this, but I think all of us, the 22-member team at Stable Money, is on the customer support day in, day out to understand the problems for our customers. One very interesting data point that I also want to talk here is that 50% of the AUM that we are booking today is coming from two sets of customers. One is people who are investing in 9 to 10, 12% kind of platform, but are riskier assets, and they are moving their money to similar 9%, but a more safer assets like FD. And some people have booked in FDs at a 5, 6%, and they're breaking those FDs and coming onto our platform and booking the FDs at a higher interest rate. This is very encouraging for us, and some of the features that I'll come and talk in next few minutes is derived from this particular insight. Another important thing, even just 1 month, 1 out of every 3 FD that is getting booked on our platform is by the repeat customer. So somebody who has booked FD with us in last 1 month is coming back and booking another FD with us, which is very encouraging sign for Stable Money. And though India's digital story is still growing, and we are talking about the growth of Indian digital investments, we still believe that Stable Money has a role to play. And we are doing a bit of our role where 25% of our investors are doing their first investment on a digital platform. That's very important. It's not their first FD investment. It's first of their any investments. And we have customers from 300 cities. And some of the cities I don't even know, despite launching 300 cities in Swiggy. People are coming from these cities and doing investment onto Stable Money, which is really good. And I think the most important part, right, we have spoken about Stable Money and how people are trusting it, but we realize that this major trust is borrowed from some of our partners who have with us. Bajaj Finance, Shivalik, Shriram, Utkarsh, and Axis. These are some of the bank partners who are already live onto our platform. And when anybody invests in Stable Money, the amount directly goes to the banks, and they send you the instant receipt. And when the FD is matured, that amount directly comes from the bank to you, right? That's how we have built this infrastructure, and that's how we are building the trust with these banks and our customers. That's it, guys. But we have something more to talk about, right? And I won't take more than a couple of minutes. In last 1 month, another interesting thing that has happened is a lot of customers have reached out to us with genuine care for Stable Money. And we have got calls from Dubai, we have got calls from London, we have got calls from multiple other countries as well, along with India and different cities. And they have not only gave us the feedback about how the app is and how they like it and what are the changes, but they also gave us some feedback around improvements that they want onto the platform, right? And that's the one thing that we have taken very seriously. And we have launched some of the features, and we are launching some of the features, and that is what we want to talk first time here to anybody. So the first important feature which is went live today morning is FD laddering. And if you have seen, when we spoke to a lot of these top 1% of Indian investors, how they look at their FD investments, they look at FD investments very differently versus how we look at, right? And I like another mention to my parents, but they have kept their entire money in one bank for the same tenure. But when we looked at how people do investments, they talk about FD laddering. They talk about how do you do 1 year investment, 2 year investment, and 3 year investment across the different interest rates. and keep reinvesting that amount as and when FD matures so that you get the benefit of changing interest rates for you, right? And we thought that we want to bring this feature to our customers because we don't want to build a platform where we ask customer their money and say that we will manage your money, you don't worry. We want customers to be experts. We want customers to know exactly what they are doing and why they are doing, right? And that's one of the important features that we have launched today. And we would love from the people here and from the people who are seeing us online to give us the feedback on this. Another important, and this is first in India, the most important question that we have seen from the 50% of the customers who are breaking their FD and coming onto our platform is that they still don't know how the breaking FD works. Like traditionally, people feel that, I remember when my parents used to go to branches, they used to say that don't break FD. If you break FD, you will not get any money. And they always thought that breaking FD means you will get only principal amount, right? And nobody very clearly talks in India about if you break FD, how the breaking charges are, how the penalties are. And we are building India's first breaking FD calculator. There are a lot of calculators and India runs on calculator, right? Some of the searches that you will see on how the calculator searches are there, that's massive. So we are building India's first FD breaking calculator where you will come and put your details around investments that you have done in any bank in any tenure and will tell you what will be the approximate penalty charges, right? So that's what is coming soon in another week. Another thing that is coming soon is how do you switch FD, right? People have a lot of people have seen switching home loans. But switching FD is something that we feel is very critical for the users because anybody who has invested in past couple of years in FD must have done it at a very low interest rates. And when they see that FD interest rates are 9.1, they are a little uncomfortable, but they don't know if they break FD, what will be the charge? And if they reinvest in these higher interest rate FDs, how much additional gains that they'll make. So that switch FD feature is also going live in another week. One more important question is, as I've said earlier as well, is that people are trusting the banks and they want banks to take care of this, right? So we want to answer every question that they have around the bank. So know your bank. Currently, we talk about some of the bank and some of the details about the bank onto our app, but we are enhancing that. So you will have more details, everything, because some of these banks, people might have heard separately or people might be seeing it for the first time. We are giving every possible detail around the bank so that you guys can build the trust and do the investments. So these are some of the features that are going live. But one very important thing and the last thing that I'll talk is what are we doing next? We have spoken everything for the last, 5-7 minutes about how we are building, but we realize that we still have to talk to a lot of customers and talk about how the FD investment or a fixed income investments is happening and why it should be a very critical component of your investment portfolio. So what we are actually doing is Stable Money is doing an India tour. We'll be going to 15 plus cities in the next 3 months. We'll be physically present, we'll be there, the entire team will be there, and talking to the customers across all these cities and help them understand their FD investments, help them understand their fixed income investments. So that's one thing that we plan to do in the next 2 to 3 months. So the people who are seeing it on, seeing us live will be coming to your city. So we are looking forward to seeing you there. Cool. Thank you so much. We took 12 minutes. I just wanted to ask Ruchika that, Ruchika, in last 12 minutes, can you just quickly see and let me know how many FD bookings we have done? Okay, cool. So 11 bookings in last 12 minutes is, so we are doing one FD booking every minute for a platform which is 1 month old. I think it's a big feat for us. But thank you so much. Thank you so much for coming here.
Thank you so much, Saurabh, for sharing this with us. I think Saurabh talks a lot about how everyone is awake till 3 or 2. That's largely because Saurabh is also awake. And in terms of, the calls that we get or the support that we provide, I think there have been funny instances where people have called Saurabh with some doubt and they've been like, Arey, but you will not know, you're from support. So he has to explain to them that he's, actually the co-founder of the company. And a lot of us speaking to people do not do this as a support process. We do it because we actually want to speak to users, understand from them how they feel about the platform, and solve their queries to the best of our abilities. So, Saurabh took a lot of time to talk to you about, how customers reach out to us and express their gratitude for resolving queries or providing them with a service wherein, they're able to make FDs so quickly. And even I have a lot of instances, but instead of us talking about it, we thought that we'll show you a video which sort of showcases the love that people have shown us. And it's a lot, right? So we invited some of these people in our office, took their permission, and whatever they felt comfortable sharing with the rest of the world, we put together in this small video, and we wanted to share it with you guys. Could we please play the video?
The company being so transparent in showing us other options as well outside their scope, which they haven't collaborated with, probably banks and NBFCs, which are not yet onboarded. So, I mean, displaying such options for me and to provide me with that sort of analysis and benchmarks to actually figure out where I'd want to invest is actually a great move. So I really appreciate that, sir.
But when I went through the stable money application, there were various options. So I was glad to see there are even FDs which are giving 9% returns. So herein I thought, yeah, so I can also invest in FDs and get as high returns as 9-10% here as well.
I think when I went through the Find My FD option or the feature, I could see the flow was very simple. Okay, what is your tenure? What are your goals? What is the interest that you're looking for? And these are the 3 or 4 different options that you have. Choose. Usually it would take me like what, 2 days, 3 days to figure out one, and I would not even figure out the best one for me. So I think it sort of helps me with that.
You wouldn't be able to compare across FDs from different banks because maybe those FDs information just lies in a bank's web page, and you can't, like, you have to do your manual comparison, maybe write that down, put that on a spreadsheet and do your own research there. Whereas here you have that spreadsheet abstracted away and you have it presented to you and you make your decision. I think that in itself is just enough. Like you're able to just complete it with a tap of a button, just one complete flow, like how you would order like a Swiggy or like a Uber or something like that. So it makes it that much easier.
Comparison and deep diving into each of the banks in your app, I think it's a quick way for me to just do that comparison, understand what's going on where, and know more about the FD market.
Or an app, right? That is where I would make my purchases. So Stable Money offered me that, right? The experience was very clean.
Normally on any other normal day I would not have thought of switching my FDs in the middle of a tenure, but this feature really gives the perspective of only, okay, this is only the percentage of loss you'll be having, but this will be the interest you'll be getting at the end. Yeah, so sure, I would recommend Stable Money to my friends.
Okay, so that was the last of the videos that we wanted to show you, and the last that we wanted to talk about Stable Money as such. We'll now move on to the panel discussions, and while you've all heard from Saurabh, I'll now invite our co-founder Harish Reddy on stage, who will moderate the panels going forward. Harish, please take it forward.
Thank you, Ruchika. So I come from the world of algo trading, and I tend to be extremely calculative about my investments. And to be very honest, a couple of years back, I would not have allocated a lot of my money to fixed income. But with the landscape changing, with the interest rates going up, now I allocate a big portion of my savings to fixed income, and I force Saurabh also to do that. And that's where this idea of Stable Money was born. For a brief moment, I'd like to move away from FDs and fixed income and talk about asset allocation and financial planning as a whole. This is one of the very important things that is missing in our formal education system. I think there's a lot of focus on improving the earnings that you make, but there is less focus on growing that. To discuss that, we have a very eminent panel. I'd like to call upon stage Mr. Kalpen Parekh, who is the MD and CEO of DSP Mutual Fund. I can imagine the pressure that Kalpen has to manage over 1.3 lakh crore of AUM when we at around 100 crore of AUM feel so much pressure. A lot of my money is with your team, Kalpen, and I imagine a lot of the money of the people present here would also be with you. Kalpen has over 20 years of experience in asset management. Thank you for being here, Kalpen. We now have Kirtan Shah. Kirtan is extremely passionate about financial services, and he has co-founded Financial Planning Academy and is the MD at Credence Family Office. He's also co-authored 2 books, and he's a very popular name on the media and is quite often seen on television. Thank you, Kirtan, for being here.
So one of the first things that Saurabh and I did when we started Stable Money was to give the NISM RIA examination, because we wanted to be RIA at the beginning. And we could see how boring it was, extremely calculation based. And I think most of the financial planning theories that you see on the internet tend to focus on calculations more and not on the emotions part, the EQ part of the investing. I'd like to focus more on that with the panel here. We have Kalpen, who is more on the production side of the investment products, and Kirtan, who helps people choose the right set of products. So before beginning, briefly, I'd like to understand from you the importance of financial planning. So for an average person who spends 30-35 years earning his income, how critical is financial planning to maximize his wealth by the time of his retirement? I'd like to start with you.
Thanks, Harish, first of all, for endorsing on YouTube that you are an investor. So like you have booked 12 FDs, I'll just check with my digital team how many new folios we have booked after your comment. So thank you for inviting me here. So rightly as you said, we do money management very accidentally. We do all the jugaad in our life for the first 25 years to, get a degree and get a job. And once we start getting money, we actually have no clue how to invest. And all our investing is fairly anecdotal, random, depending on what the crowds are doing, what people around us are doing. So the formula to earn money is 25 years of hard work by parents and your teachers and you yourself. And the formula to invest money is not even 2 minutes of thought given to it. So the need for financial planning hence is very, very important because, remember, most of us have 15 to 20 years of zero salary life after we retire. And in today's world, no one cares about it because it's too far a goal to even visualize or think about. And, with more and more focus on fitness and how people are trying to stay fit, if they end up living longer but, have no money, appropriate size of money to manage that phase of zero salary, it would be challenging. But more importantly, we need to respect our money when we invest. I feel that many investors or most investors don't have a framework of investing, and that framework of investing is about availability. Whatever is available in front of me, it's driven by that. Whatever is doing very well right now, whether it is suitable for me or not, whether it's right for me or not, we just end up investing. It is like, in fact, we do a lot of these discussions, panel discussions, video interviews with many platforms, including younger platforms like you who are providing the distribution leg of money management. I'm very often, almost one question which is the most popular question, and according to me the worst question, is which is the best fund to invest. It is like waking up in the morning and randomly calling up, CEO of Indigo or CEO of Air India and saying which is the best flight to take. Now, first, you need a lot of other context that, who are you, where do you want to go, which city are you present in. So a lot of other, so with money we are so frivolous, and I think that is where the role of financial planning and the role of genuine, transparent, authentic, honest education becomes very important.
Thanks. Ketan, you.
First of all, thank you so much for having me, and congratulations on the launch. Because Kalpena has already spoken about investing, I'm going to touch upon the other part of financial planning which is generally not spoken about. Today you look at social media or most of such panel discussions that happen, right? Most of us are only discussing where to invest, how much to invest, where will I make more money, right? But one part of financial planning that is extremely important is the risk management, right? Today, I'm sure most of you all sitting here in the audience would have heard that it's a common saying in India that we are just one instance away from bankruptcy, right? So one medical emergency that you and I will have, 90% of India is going to go bankrupt. Because most of us don't have a Mediclaim or a health insurance or term insurance to a larger extent. Imagine somebody whom you've coached that start investing early. He starts at 25, right? Does an SIP. Till 30 is able to save 5, 6, 10 lakh rupees. One medical emergency and is bankrupt, right? So financial planning, definitely investing is a big part of what financial planning talks about. But financial planning also makes sure that your risks are taken care of, by which the wealth can grow and you don't have to break it for various reasons, right? And the other extreme end of financial planning is also transfer of wealth, right? Estate planning, writing a will, trust. I don't know how many of us in the audience here, irrespective of the age, have a will today, right? And if you go back and check, right, there are so many problems, and we deal with families and we exactly know what they actually have to go through when they don't have a will or a trust in place, and if there is a sudden emergency that happens in the family, right? So financial planning not only helps you reach your goal and helps you build wealth, it also takes care of risk management and ends with transfer of wealth to the next generation. And which is why I think it's extremely important that all of us here take financial planning a little more seriously, and it's not just about investing.
Got it. And I'd also like to, get some attention onto the recent tweet of yours, where you quoted Axis Mutual Fund's research saying that the funds, so I think one of the funds on an average had returned 19% CAGR, but the investors only made 12%. And all the multi-asset fund, I think the fund returned 12%, but the investors only made 7%. I think the first noob question is, where does this money go? So the market cap has increased by that much. The retail investors are not making the money. Who's making the extra money?
See, I think in investing, and like rightly Kalpen said, you wake up asking the right question, or rather the wrong question, which is the best fund to invest in. There is no best fund to invest in, right? As an investor, look at it this way. What do you really need to be able to generate wealth, right? You will need to invest, one. You will need to invest for a long time, right? And probably returns are incidental, right? Now imagine as a retail investor, what do you have in your hands? All that you have in your hand is try and invest as much as you can and stay invested for as long as you can. What you really don't have in your hand is returns, right? But the bigger problem with most investors that we talk to, or in general, is that they want to focus on something that they cannot control, which is returns. And they don't want to focus on something that they control, which is stay invested for a long time. And which is why, to quote one of the recent studies that even Morningstar did, that 70% of the returns that you actually generate is allocated to having the right asset allocation, right? But most of us today only want to chase being able to generate higher returns, right? For me, let's say for example, even if I make 8% on my investment, but if that 8% is helping me sleep peacefully at night and reach my goal, how is it different from making 12%? At the end of the day, you want this money to be able to reach your goal. Of course, it's not bad to have 12%, but the point that I'm trying to make is that even if at 8% I can reach my goal, why not? The reason why I told you this is because I think from a retail investor standpoint, the only thing that the retail investor can control is her behavior, right? Nothing else is in her hand. And if you can't control your behavior, look at yesterday. I mean, I and Kalpin were just discussing, one day of market fall and you see social media talking about how the growth story has gone and long-term investors have started becoming short-term investors. The more you keep seeing the app, the more you check your returns on a daily basis, you're not going to be able to control your behavior, and that's the biggest problem. And as a retail investor, that's your only asset. So if you are not able to control your behavior, your returns are always going to be lower than the fund's return.
Understood. So would you agree with that? Nifty at 20,000 gets you more investors than Nifty at probably 10,000, 12,000?
Actually, when Nifty reached 10,000 the first time, that time also we got more investors. So every time you see good near-term returns, you obviously get a lot more investors. The even biggest flaw, it took me 12 years to realize that I'm myself a victim of this flaw. So itna aasan nahi hai. You know, basically we react to available information, and the most available information about investing or stocks or mutual funds is what return has it made in the last 1, 2, 3 years. So you go to any website today, you know, all the digital websites, the starting point, the big premise is convenience and transparency, but that transparency is harmful. What you're starting off is by sorting what are the best performing funds. Now when you see that in 1 year this fund has given 30% return, it's not yours, it is someone who invested 1 year back. So most people think if I'm buying a 30% 1 year return fund, it is mine. Your returns are going to come only tomorrow. Your starting point is today. Long-term average returns of equity, you know, as an asset class, world over, is only 4 to 6% more than the inflation of that country. So if the inflation of our country is around 6%, our long-term median average returns will be between 10 to 12. So if you have earned 30% in the last 4 years, something has to take it away. You know, buying high returns is the challenge, and that is why every time markets are at a high, new money comes in. Funds or sectors which are at a high, new money comes and chases that. And you know, the question you asked, I'll just you know, unsolicited response to the first question you asked, Kirtan, was just go back to 2008 January, which was in a way the first peak market for India. If you invested in Nifty on 1st Jan 2008 till today, 15 years have gone, I think Nifty returns is around 9%, right? If you invested just 9 months later, in October 2008, because by that time 50% of correction had happened. Now with 50% correction, prices came down, investor confidence came down. However, actually the market was much more safer because 50% of froth had got cleaned away. If you invested just 9 months later, since that day till today, again almost 14 years and 3-month return is 18% CAGR. So you asked where is that investor gap, who takes away? It is the disciplined investor takes away the return of the investor who chases past return. See, those who chase past returns actually are giving returns to the guy who is exiting at that point in time. So, you know, it is obvious always world over, money comes in when numbers look good. The biggest principle of sensible investing is to, you know, one, have a very long-term time horizon, have an appropriate mixture of asset classes so that, you know, you can live through fluctuations. The game is not about earning the highest returns for the shortest periods of time. The game is about earning that rate of return which allows you to stay invested for the longest period of time. Because the moment the time tenor becomes longer, in the formula of compounding, T is raised to the power of, whereas R has plus sign before it. So between plus and exponent, time has far bigger value. Now what happens is behaviorally we don't like fluctuations. Whenever there are jerks in the market, we feel like getting out. We feel nervous because our decision making was never with thorough homework. So you panic that, okay, I thought this is going to go up, but it's down 8% since I invested, let me get out. So you are buying high, selling low, repeat, and compounding is lost.
Very interesting. So you can expect the equity returns to be in line with the nominal GDP, the inflation plus growth?
Plus or minus another 2% depending on your behavior.
Understood. And also very valid point on looking at the screen. I think after a long time, Saurabh and I were looking at our portfolios yesterday after investing in mid and small caps. So yeah, so that was some extra pressure apart from the event that we have. And also on the time compounding. So if I have two options, let's say I invest in blue chip stocks and I make 12% with the standard deviation being very low, and let's say small caps where I could make 13-14% with the standard deviation being very high. If I were to look at it technically, 20-30 years down the line, maybe it won't matter, but I'll see bigger dips in small caps. So do you think we as investors should keep that in mind? What is the emotional tolerance to look at downside, even if we are in there for long term?
Absolutely. In fact, the starting point to become a good investor is to ask yourself first. So actually, like I said, I learned it after 12, 13 years of making all these mistakes. And till 2008-9, when that big correction happened, my way of investing was where will I make the best return? And my conclusion was whatever has made the best return so far is where I'll make the best return in the future. Whereas that was completely a flawed conclusion because it's always the opposite. What has given the highest return in last cycles is generally the worst performer. Then, somewhere 2008, that tube light moment happened with a 57% loss in portfolio, 70, 80%, 90% loss in, all the wrong stocks or bad stocks. The tube light moment was the first question to ask is that what is the maximum loss I can go through if my portfolio is A, B, and C, and can I tolerate that loss? And if I cannot, then adjust my risk accordingly. If I can, then adjust my risk accordingly. So start with that first. And first of all, for that, you need to know what is the loss you can make. So today, if you ask people, do you know, and which is why, at DSP, when we actually come up with ads, our ads are more educational. We actually show, our ads are mostly in red color. We show the loss first. So when we, sometime 3 years back in 2020, when we reopened our small cap fund, our first ad was minus 67%. This is the worst 1 year loss you can have if you are unlucky. Now, if you cannot digest this, you cannot think about investing in small cap stocks or funds. So it's very important to know what can you lose, and then you calibrate your portfolio accordingly. Now, let me give you another example. It is a myth that small caps make more money. Good small caps make more money. If there are, let's say 2,000 small and micro cap and mini cap stocks, less than 100 of them over a long period of time will make better returns than the large cap index. Why are these companies small? Because they deserve to be small in the first place. They are in small industries. They are in, cyclical industries. And out of 2,000, if I'm choosing only 100 or 200, it means 90% elimination has to happen. Today, if you sort all the companies in terms of highest number of retail shareholders, most, barring 3-4 good companies like an Infosys or an ITC or maybe a Reliance, most companies which have highest number of shareholders are companies which have lost 80-90% of price. And a lot of these companies have ROEs which are, either negative or less than 10. They are less than the FD rates you are giving. So if your return on equity, return on capital is less than FD, why should your stock make money? Just because it is in small cap. So small cap investing is risky investing. Good small cap investing is wealth creating. And for that, you need filtering, elimination, and so on and so forth. Over a long period of time, generally small cap, good. So thankfully, when you invest via small cap funds, the institutional intellect available across fund managers, they end up doing a lot of risk management for you. So at least the weak companies, the untouchable companies are eliminated. And largest accidents also have happened in small caps. So one framework that I follow for small cap investing is nothing in direct stocks, because unless I open a balance sheet and read and I know what is this company all about, I'm just speculating with my money. And I don't have the time, and legally also, we only invest in our funds. We don't invest in stocks. So it goes to small cap fund only as an SIP. And once in 3-4 years, when there's a sharp crisis, you do your lump sum. This takes care of the volatility. The SIP takes care of vol. And, when sharp corrections happen once every 5 years, most of the froth is out. And that's how you can, And secondly, to a lot of first-time investors, I tell them again that if you don't know where to invest, whether large cap, mid cap, small cap, then don't start direct investing. Find a good advisor, start with that journey, and then progress.
Very interesting point on stock picking versus funds. I think we realized this very recently, that even if my stock portfolio is exactly the same as the mutual fund, the tax losses that I lose due to the dividend and also the churning of the portfolio within a year more or less makes up for the expense ratio. So for you to be a direct stock picker and beat mutual funds, you need to do a much more and a much higher alpha, and the fund managers are already experienced.
Reach the rebalancing and the tax that you have to pay. So I'll give you a very funny incident. Recently, we are in the middle of a new fund launch called multi-assets. So my dad keeps listening that I'm constantly talking to my team about the new fund design. Now, novelty has great attraction. But novelty is the worst investment strategy. So the other day he told me, and all his money is in my funds, in various funds. So it's fully invested, and he has no new cash flow. So he said, I want to invest in multi-assets. So I said, paisa kahan se aayega? So he said, hai na tumhare fund mein, to udhar se shift kar lo. So I told him, shift karke kya hoga? Because the moment you shift what is your old investment, your meter for tax efficiency starts on day one again. Number one, whatever you move out, there will be capital gains, you will pay tax on it. And the tax that you pay today, let's say on a 100 rupee gain, you will pay, let's say 8 rupees of tax. that 8 rupees is losing the future compounding for the next 10, 20, 30 years. So the loss on compounding is something which is stated and not understood at all. So which is why what he said is absolutely right, that once you've found your choice of investments right across asset classes, across fund houses or whatever you have chosen, and if they are broadly right, do not interrupt compounding.
Understood. I'd like to move to asset allocation. Does adding debt to an equity portfolio create value, both in terms of return and risk management?
100%. I think asset allocation solves multiple problems the way I look at it. Let's say I meet a lot of aggressive clients who typically say that I'm so aggressive that I only want to focus on returns. Why are you adding 20% fixed income to my portfolio, right? And this is 6 months back. Forget about the rally that has happened over the last 3-4 months, and I'm quoting you data for the last 6 months. It's actually a misconception that small caps generate higher returns than large cap. And I'll quote a data 6 months back, right? And it is extremely situational. Today it may look very different, but 6 months back, 10-year rolling returns of a small cap fund was only 2% higher than the large cap, with a 19% more standard deviation than large cap, right? So had we been doing this panel 6 months back, our answers would have been, it is stupid to invest, sorry for my language, but it's not worth to invest in a small cap with taking 19% higher standard deviation, right? So while you talk about asset allocation, right, you are not talking about situational discussions. You are talking about broadly how do you really want to keep your portfolio. Exactly 6 months back, if you look at the last 20 years of data, you would understand that a 100% equity portfolio has generated 13.5% return with 16% standard deviation, right? And a 70% equity and a 30% in government bonds would have generated just 0.2% lower, right? With 10% lower, 10 points of lower standard deviation. It's a no-brainer that a 70 equity and a 30 fixed income portfolio has actually done well on risk return both versus a 100% equity portfolio. But still there are counter arguments as to saying that I'm aggressive, I'm okay with the volatility. So I keep telling everybody, even if you are in the highest risk profile, how many of us actually, if a 2008 happens, really has the money to invest more in equity? Even if we keep generating cash flows, I have at least seen in 2008, in spite of me getting my monthly cash flows, it was so difficult for me to allocate more money to equity. The most aggressive person also needs to have 20% in fixed income, even if she does not understand my first argument, saying that when the market falls 20%, this is actually the cash that you want to use to buy equities lower. So even if you are the most aggressive investor, always have a balanced portfolio. I mean, it's a no-brainer, and I don't want to talk about why a conservative guy should have this, because she'll be able to beat inflation, or a moderate guy. But even the most conservative person really needs asset allocation for various reasons that he or she might not understand while they are trying to invest.
Got it.
Harish, I want to add, you ask all the good questions to him. I'll add data that generally when markets, when valuations, equity valuations are 22, 23 times and above, and they happen once in 4 or 5 years, from there in the next 3 to 5 years, equity returns are very close to fixed income. So, again, scientifically, mathematically, at extremes of another asset class, fixed income becomes far more powerful. And, we have this very standard saying when markets fall, right? We keep receiving these quotes on our WhatsApp that, invest more when there is blood on the street. So last time when COVID happened, I sent this quote to all my batchmates, all my engineering and MBA batchmates. And one of them answered that, ye quote ke saath send some money also. Because where do I get that money to invest? Because when markets are rising, you never tell me to take some money out. And that is what asset allocation does. And automated asset allocation, so when 23rd March 2020, when markets had crashed by 40%, was a great day to invest in hindsight. And even at that day, because the data points were indicating that these are very cheap levels. After 23 years of being in the market and knowing that these things will mean revert, I did not have the courage to put more money in equity on my own. But thankfully, a lot of my money was in hybrid funds or asset allocation funds, which without telling me, they shifted exposure from a 30% or 40% equity all the way to 70 or 80. So the fund did it, but I would have not done it. And that is why, systematic asset allocation structure beats human intellect or human skill or the illusion of human skill that we have.
Yeah, I think my next question was on gaining that courage to invest in the COVID scenario, but yeah, systematic allocation must beat equity. And also, if I want to create a debt and equity mix in the portfolio, what is the best instrument within the mutual fund structure that we have right now?
See, many times we have 25 funds. So many times if you were to say, "Kahan dalna hai paisa?" I have to first think and I have to ask you. So if you put a gun on my head and say that, give me just one fund. And I'm not saying this because there is a new fund which we have launched right now. But the launch is with that thought that if ultimately asset allocation is the source of long-term compounding and allowing you to stay long, any fund which mixes asset classes, either a combination of debt and equity, and over time more asset classes have become available. So we believe that funds which combine good Indian companies, good global companies, some fixed income, some gold, these four combinations are a very sensible way of building long-term wealth. Periods like 93 to 2003, when equity markets in India gave zero return, gold went up by around 13% CAGR. Periods like 2008 to 13, when Nifty was zero, because first it fell by 50%, it recovered the entire thing by rising 100%, but still you are back to zero. And for 4 years was again going nowhere. Gold went up 300% in those periods. Now, gold is a wild animal. There are very few techniques to know when is it going to run or not run. But in the long run, over the last 25 years, Nifty returns are 12% median. Gold returns are 11% median. When you mix the two, the mathematical average is 11.5, but the investor return actually is 12.5 at lower volatility. So basically, if you are able to curate asset classes with low correlation to each other, which is, stocks for long-term compounding, bonds for, short-term defense, and reusing it when markets fall, or to give you the comfort to stay for long. I'm adding global stocks today because, biggest profit pools of the world have got created outside. And today, there is a way to invest outside in a smart, tax-efficient way, so why not leverage that? And a lot of Indian stocks, which are great companies, may not be great stocks because prices have run up a lot. Whereas global, so yesterday, Oracle announced their results. Results were disappointing. Stock was down 20%. So price discovery is very fast. In India, you hardly see that happening, at least in these times. And then gold again, for 5,000 years has stored value. So I personally am a low conviction investor when markets are very confident. I am less confident. When markets are, very worried, I will reduce my asset allocation to the underperforming asset class. But today, when equities are doing extremely well, I get nervous.
Understood. Also, does the multi-asset fund that you are launching also take care of the taxation on the debt mutual fund piece?
So basically, its taxation is 20% tax after accounting for indexation. Now, the beauty of indexation, thanks to the government, they've said that India has inflation. Take advantage of that inflation. So whatever gains you are making in your investment, net off the inflation first, and then whatever is the pending gain, on that you pay tax. So that's the beauty of combining asset allocation. And it's not about the multi-asset fund alone. There are other funds like equity and bond funds, balance funds, dynamic asset allocation funds. They all achieve the same objective of mixing asset classes in a tax and cost efficient way. And all the income that you earn, dividend income, interest income, all of that is converted into friendly capital gains, which get taxed at lower rates after indexation.
Got it. I think we've almost run out of time. I'd like to take a couple of questions if you have any.
Hello. Yeah. I just wanted to ask Kalpin, do you invest in FDs?
In equities, FDs?
FDs.
So it's your launch. It's a tricky question, but yeah, see, I thankfully started my career in 98. 99 straight into a mutual fund company, and fixed income funds had significant tax advantages, so all of it was into debt mutual funds. Now hence the need for FDs for me never happened. On the other hand, this year onwards that tax efficiency on debt funds has gone away, but again through hybrid funds I do get that same tax efficiency. But to a lot of people who don't have that high tax bracket, or the need for, like you mentioned about your parents or my parents, who don't get new income, so their tax slabs are very low. For them, FDs are great because it gives them a peace of mind. So a lot of my elders in the family, I tell them that you don't have to necessarily be in mutual funds just because I'm wearing a mutual fund t-shirt and, myself a mutual fund investor. Depending on your risk profile, you should do that. Personally, my investments are 99.9% in mutual funds. Because I understand that differently, I breathe that and I believe in that. And it's worked for me over 25 years.
Kirtan, do you invest in FDs?
No. Look, both of us here probably have this notion that we understand, right? And we want to live that and believe
Thanks for clarifying to me.
No, I took that liberty because we spoke about it, right? So, we would like to believe that we understand, right? And hence we might be able to generate that alpha which otherwise would not be available. But I was just talking to my dad last week, and he's got a lot of money in FD, and he still does not believe that I understand, and so I'm not his financial planner. I'm not sure, and you all should check, and I'll give you the name. Just day before yesterday, we moved his FD onto your platform. So, for people who don't still trust us, right? And trust may not be the right adjective, but probably, it does not fit the way they invest. They still would want to. But people like us who have the notion that we understand, we probably believe that there is probably opportunity outside that we can leverage on.
I want to also add, when Saurabh, you were presenting, and the concept of laddering FDs is a brilliant concept because interest rates keep changing, and most investors on their own don't know how to take advantage of that. So it actually resonated with me, and actually when you said 7.5 to 9%, different rates are there. Today, bond yields are only 7.5%, but if some banks, with the right curation that you are doing, with the right risk management and understanding of that, 8 to 9% is a compelling rate of return today when other asset classes are fairly attractive.
Kirtan, please refer your dad for stable money.
It's already done. I'll give you the name. Check your.
Yeah, there's India's biggest referral scheme going on, so please take advantage of that. Thank you, Kalpen and Kirtan. Sorry?
You gonna pay me for that?
Yeah. Stable money is going to pay you for that. Thank you.
I'll do something then.
Thanks, Kalpen, and thanks, Kirtan, for this.
Thank you so much for having us.
Thank you.
Thank you, everyone. Now we'd like to bring back the focus on fixed income and FDs. I think one of the major critiques that we get after launching stable money is people saying, yeah, FDs don't beat inflation. So I'd like to discuss that more in detail with the banking experts that we have here, the representatives from two of the banks which have the highest FD rates in the country. So at least these banks, beat inflation. I'd like to call upon Sanjay Sharda onto the stage. He's the head of consumer banking at Utkarsh Small Finance Bank, has been a banking veteran with over 30 years of experience. He's previously worked with IndusInd, Kotak and HDFC Bank. We also have Keshav Mishra, who is the Executive Vice President at Shivalik Small Finance Bank. He heads their digital banking division. Keshav has had experience with digital banking and has previously worked with Open and also had a long stint at RBL Bank. Thank you, Sanjay and Keshav. So just to set some background, post-COVID in 2020, in 2021 and 22, there was a sharp rise in inflation. I think it was personally very surprising for me to see US inflation numbers being so high and also rupee weakening against the dollar, which means the rupee's purchasing power globally has gone down more than the dollar. I also saw the Indian inflation numbers, and that did not make a lot of sense to me because it said 6-7% rise. But whatever consumption I had, my rents had gone up significantly. The price of a car, price of mobile phones, holidays, hotels, everything had gone up. So I felt there was some disconnect. And when I look at my investment decisions, I need to understand my own inflation and see if my wealth is growing in proportion to that. So do you think retail investors in the country should understand their inflation first, apart from what the CPI numbers are, or do they average out over the long term?
Yeah, so I think it's a mixture of a couple of things. One, that of course inflation is measured in the country as CPI and WIPI. Now for most of us, some of these things do not really make a big impact. So what will make impact is my rent has gone up, my car EMI is going up, or my home, in fact car EMI does not go up because once it was locked in. But if there's a home loan EMI going up, I think that is what really pinches most of the people. And that's where you need to decide on what are the factors which are affecting you more than the WPI, CPI, because mostly it's fuel and food prices. Now you might have expensive habits which do not necessarily correlate with any inflation number. So then you need to figure out whether you can categorize your expenses the way they are supposed to be. How much you're spending on food, how much you're spending on transportation, what is your EMI in a month. If you can categorize those and make adjustments or ensure that you have a higher income, or if your income goes down, how flexible are you in that? I think that's what matters most to an individual mostly like us. Food inflation matters to people who are lower in the income category, but then the government has such wonderful schemes for them, so it really doesn't make a difference. But yes, it does pinch you. For example, like you said in the US, when I just gone to drop my daughter last year. I mean, the same Frappuccino in Starbucks was like $3, now it's $5.50. Okay, and suddenly they are looking at us as ways to digitalize more than we used to look them. When I went to study about 30 years back, it was a very different ball game to compare to what it is today. It's been a very interesting 1 month in the US because suddenly I realized how valued and how advanced is India compared to whatever time I spent here. It's unbelievable. Because I had gone to open an account for my daughter in Chase Bank, and they made me sit there and understood what is OTP, what is Aadhaar, what is UPI. It was an amazing experience from the first job I got in Pittsburgh, wherein people say, "Oh, India, okay, please, okay, you are one of those, many." It's been an amazing journey. So I think, yes, inflation is critical, and I'll come back to the topic. I just diverted a little bit. But you need to understand which are the things which are really biting you more than just look at the number and get, what's hitting you. Because if you do not have a home loan, doesn't matter whether the home loan rate goes up or no. Right? If you have a car which is already paid for or you bought it on your own, savings, then the EMI really doesn't make a difference. So it's a matter of choice, and more so on how you can able to adjust within your income band. I think that's very critical, especially for a person who's salaried. I think that is critical. So you need to have a very clear categorization of your expenses, and those are which you cannot live without, and those which you can give away. So that will give you a good headway on how to adjust inflation.
Understood. I think also on the flip side, the recent rise in the tomato prices would have had a bigger impact on CPI, and not on me, especially because I'm a South Indian. We don't eat as much tomato as the North Indians do. So that was a positive for us.
No, but I guess, I think even infected the McDonald's and Burger Kings. They stopped putting tomatoes in the burgers.
So Keshav, your views on personalizing inflation, for investors?
Yeah, so as Sanjay rightly pointed out, right, inflation as a number, the CPI number that we see, is not a consistent number for everybody, right? So even when you look at an index point of view, earlier they were talking about index, right? When an index, you see the return of all of them in weighted average calculation, right? But some of them have overperformed, some of them have underperformed. That's exactly what happens with inflation also. Now, because it's a basket where you have given weightages to certain kind of, let's say, food, fuel, etc., it is not consistent across every household. It's a very personal thing. And considering the kind of demography that we have, a lot of it is a divide between rural, urban, and even within urban it is large cities and slightly relatively smaller cities. You will see people who are in early stages of their career. A lot of millennials are coming into the workforce, right? Their inflation and their aspirations are very different. So typically what ends up happening, like for example, I have a joint family, my parents also live with me. The inflation that they will be encountering today will be way different than what I will be encountering, assuming that we have our own set of finances and the way we manage. So it is for each one of their own. And I think one of the important things to remember is that irrespective of what happens in the in the inflation side, it's very difficult for you to have a control on that, right? And just like what they're talking about equity, it is very also it's also very important that something which is not in your control, rather you focus more on things that you can control. For example, regular investment, saving, and asset allocation. So it pretty much boils down to that. And considering the compounding that takes place, there will be years where the inflation will be more. And also if you see from the deposit, because that's the product we're talking about, also the rates have a very strong correlation to inflation. So it plays out for you in the longer term.
Understood. And in this background, how do we look at fixed deposits? Is it a medium to preserve wealth and be extremely safe, or could it also be looked at as a wealth generating kind of a product?
I will divide it in two parts. One, your basic financial planning. What is your allocation in terms of how much are you putting in investments, how much are you putting in deposits, how much cash you need. On that basis, if you are, if you have your right allocation, I think then it's very good to have a certain amount of it in fixed income. Fixed income could be your debt mutual funds or could be deposits. I would still prefer deposits because it gives me a slightly peaceful mind, because I don't have to worry about whether it's going up, down. I know that this is, if I'm putting 1 lakh, I'm getting 8%, I'm going to get 8,000, whatever, at the end of the year. So I don't have to really worry about it. So that's where my fixed income is there, because it gives you a lot of stability. That's the basic idea, and it's something which is there. It's not going to, hopefully bank is not going to go bankrupt. So it's there. So you are, you're assured of that peace of mind. If you want to take punts in life, of course, then equities is the best thing. And that, as you age, you keep on adjusting your equity holdings and reduce them, or basis when you start compared to when you start. Like my son, who's just started it, is working in IBM. I've told him, put all your money, whatever you're saving, into equities. Do not think about fixed income at all. Whereas now I have, cut down my equity, because I have a lot of exposure from the ESOPs, but I've cut down my fixed income is only FDs now. So I think that is what matters, and it is a good, I've seen a lot of people also, some of the, people I met, for example, in, Chowdi Bazaars and this Crawford Market and all, they have a very thoughtful concept which I was amazed. He said, I have 15 crores or 20 crores of deposits. मेरा इतना income मेरा हर महीने आता है. I don't have to worry about anything. So that's I think that was a big statement for me when I met these people, and they say मेरे को 20 crore है मेरे पास, मेरे को 8 या 7% आता है, 6-7% आता था उस टाइम, 1.5 साल पहले की बात है. I think मेरे को इतना पैसा आता है, I don't have to worry about it. I get 60 lakh rupees a year. 5 lakh rupees per month is more than enough to take care of my every expense. So I am very short of life. I think that is a big, big statement. And actually 5 lakhs a month is a pretty good amount to live off. I think rest I can, whatever I do, I put money, I do P2P lending. In most of the markets in India this happens. It's quite an interesting way of looking at things, but I guess, yeah. So fixed income, or especially deposits, add security or a stable source of, making money, and of course can be used and can be given to the next generation. Very easy. All you have to do is make a nominee, that's it. I think that is why FD is such a big product in India. You just saw your numbers. 110 lakh customers have FDs. I think that's unbelievable.
Yeah. And you also mentioned about the cycle of inflation, right? Inflation goes up, the rates go up, and the FD rates go up, and people invest. And there is a lag of maybe 6 months to 1 year. I remember people just after COVID must have locked in their FDs at 5-6% and face this massive inflation in 2021 and 22. So how does one be very opportunistic with this? Right now, I think we have the other extreme playing out where you have FDs at 8.5-9% and not sure of the inflation or how it's going to pan out in the next 2 years. So how does an investor think about investing here?
Yeah, so there are two categories, right? One category of the investors who are putting in incremental money month on month. A large part of the segment that you are talking about will be putting something, let's say in the form of an SIP. They can do a recurring, or you can just say that, okay, every month I'll put in. For those customers, it doesn't really matter because it gets averaged out. For the incremental deposits, they get the prevailing rate at that point in time. For the customers where the delta is, let's say, 300 basis point in your example, they'll also have to be cognizant of the fact that when they withdraw that money, they'll get some penal interest rate as well. So effectively, maybe they'll let go of that 1%. So is it worth letting go of that 1% for the gain of 3%? But you have to look at it at a tenure. So let's say if I placed an FD at the time of COVID, let's say 2 years back, right? And the FD is about to mature in 3 months from now. Is it worth, getting that 300 basis point extra for the remaining duration? Because you are comparing apple to apple, right? So you're saying 2 years, that time was 5% and now 2 years is at 8%. When he'll place the deposit, he'll have a lock-in period of another 2 years and not necessarily the 3 months which is remaining on his deposit. So, so you'll have to balance that out, right? And effectively, if you add the two, you'll realize that it's better that, let that FD mature. But let's say if in a very initial stages and if it's just 1 month and then suddenly, that doesn't happen usually. The delta that you see is on the hindsight, right? So in such cases, usually what happens is that you mature the FD and then place the FD with whatever the best rate available. And while we have been talking a lot about, democratizing this whole process, and especially the point that I want to build on what Sanjay said, is that if I had to open an account to place an FD with a bank, and I think that's one huge thing that as an app that you guys have solved for, right? And when we built that product, the purpose was that, as a small bank, small finance bank, we don't have that kind of distribution reach compared to the larger banks. So two major problems. One is this, that I don't have to open account every time I want to place the FD. And second thing that has not talked about is that I have been an FD investor for a very long time. And even 3-4 years back, when I was to file my income tax return, I'll have to go back and ask each of my bank to give me an interest statement. How much have I earned? And then in my income tax return, I'll have to give the details of those deposits. And with the introduction of AIS, this year it was like a seamless experience. All my deposit, interest, everything was in one shot. And I think that also solved for a lot of this problem, that at the time of income tax return, you don't...
I'll tell you an example. I went to file my return. I gave my CA a full file. He's saying, I don't need anything. Everything is there.
Yeah.
It's so amazing.
And look at the convenience, right? I mean, we are at a point where customers can have a lot of flexibility from, where they want to place the deposit. Is it rate? Is it is it the convenience, right? And some of those things. The other thing that I want to add is when we were creating this product, we were not only concerned about, getting the deposit from the customer. We had a lot of discussion around what happens to nomination. What happens, how convenient for him to, let's say, break the deposit, or, things like form 15, 16, 15H and 15G and H, right? 15G and H, when they have to submit, is it something that can we digitalize that, right? All of that is something that we kind of, debated, and we are in the process of building each one of these so that the customer has comprehensive experience and they can be, be assured that everything is available in one app.
Yeah, perfect. I think going back to the breaking FDs and seeing which one is lucrative, Stable Money has built that feature which is called Switch FD, where you can enter the details of your existing FD. We look at the best FDs available in the market and let you know if you need to break that FD or book a new one. And also on that note, why do banks understate the FD returns? Because I think one of the things that you mentioned is when an Utkarsh bank says you have 8.5% interest rate for a 2-year tenure, it is quarterly compounding rates and it actually amounts to 8.77%.
That's the RBI diktat. You're not supposed to give YTM, you're supposed to give the actual rate.
Understood. So that actually makes the comparison very difficult when you look at Nifty or even the...
If I add the compounding, 8.5 would be 8.78, 8.9. 8.8, sorry.
Yeah, just like in Nifty, what happens is the dividend adjusted return that you see in the index, right?
Right.
So when you have the total return index, you basically add the dividend, right? So I mean, some of these is pretty regulatory in nature. We have to comply to whatever is the prevailing norms. But yeah, it's a quarterly compounding, and that's consistent across all banks. So each bank has to provide that for on a quarterly
Basic
basis.
rate only. You can't give a compounding rate.
Got it. And now coming back to the point that the interest rates are probably at a peak. Do you expect the rates to fall in the next 1 year or so?
I think Sanjay should take that first.
It's a mixture thing. I think when you look at the world economy, the war is playing havoc till now. I don't know for what reason, but Ukraine is too small to really make that much of impact. But I think the Americas and some of the European countries have made it bigger than life, and that's somewhere affecting their mind and the inflation. I see inflation pretty much at the peak now. Maybe over the next 6 to 9 months it'll start going down. That's my thought. And then you will start seeing the interest rates going down. So maybe, let's say by December or March, I think that is where the time when I see interest rates to slide. In case the reverse happens, the war escalates and China again thinks is bigger than world, then of course then things become very sad. They start invading in Taiwan or something, then of course things will really get ugly.
And it is in line with the RBI, monetary policy. If you see, towards end of this year, I think they're expecting the inflation go down to closer to 5. And when that happens, I think there will be a little bit of a cooling, because as a regulator also they'll have to balance between growth and inflation. And I think it's always a $1 million question at every point in time, which is better. But that's for them to solve for. But I think what eventually will happen is that there will be some kind of a softening of rates.
So their band is 4 to 6%. Right now, what just came yesterday was 6.7. So it's still higher.
Yeah.
So they will probably hold the rates this time. And hopefully with all these tomatoes, onions and all going down, I think probably...
And we shouldn't forget there's an election,
election
soon,
coming
right?
up,
So that will also have some effect
that will
in terms
have
of the
a,
policy.
yes, of course, 24.
So before the election, the policy rates go down. Is that the suggestion?
Could be, I think.
Okay.
My thought.
That's one of the factors that will definitely play a role. Come down or not is something. Yeah.
Understood. Should therefore the investors at stable money lock in higher yields for longer tenures?
Yeah, I would say you should log in for 2-3 years. If you can get this rates right now, please lock in. Would you agree?
Yeah, I agree.
Got it. I now want to move to the future of FDs in India. I think FDs has been predominantly the favorite investment product, but is still identified as the product for older generations and not for new gen population. Do you think the share of FDs in the investment size is going to go down
So
over
I
the
had
next
a
few years?
great boss who just retired 2-3 weeks, 1 week back, Uday Kotak. Because I spent 6.5 years with Kotak. And you say that India is changing from people of fixed deposits to investors. That is where the shift from deposits to money stock exchange is happening. But while I see that happening, but still a certain portion of your wealth is going to be in FDs. I think that will not reduce, because the stability factor has a big play in everybody's mind, whether it is younger population or it is the slightly mid-age or elderly population. Certain amount of money will remain in FDs. That is given. Now it's been there for the last 100 years or plus. Will remain like that for another, I don't know how long. But it will be there. So that FD will not go out of fashion. Yes, you would probably see incremental money coming in mutual funds and all, and there you can see that every month the number of SIPs is going up, the amount which is going to SIP is going up. But it's not that deposit coming down. In fact, there's a huge war of deposits in the bank. The lending is going up, deposits are not enough. So there is an alternate movement to mutual funds, but FD will remain. That is my assessment for another 100 years at least.
Would therefore the ease of booking an FD also make a huge difference? Because
see, everything, if you look at it from making, I just remember when I was a little kid, I used to make, get those noodles and used to make them now with the Maggie, that Maggie which is come in 2 minutes. Everybody wants 2 minutes experience now. So I think yes, this platform will make a big difference.
No, I just want to add on what Sanjay said. So one is this whole convenience part of it, right? Second is look at it from the cost perspective, right? If I have to, let's say, reach out to every part of this country, right? I'm going to have to open, I don't know how many branches, right? Now
6,000.
yeah,
6,000.
perhaps even that will be less, right? So the point is that that adds to the operating expense for the bank as well, right? If we can figure out a way that, we can provide a better or the same level of experience without the need to open so many branches, I think end of the day that will reduce the cost for the overall industry, banking industry, and the loans will be more efficient, the rates will be much better, and some of that benefit will go back to the end consumer. So the way I look at it is that it's something that going to have a very profound impact in the way deposit as a product category will be looked upon. And and I think there will be more innovation in that, right? So there could be, FD also provide you kind of a security against which you can take a loan if there is an emergency, right? So we have product like overdraft product. We will be working on various credit card product to be backed by FDs, right? Those are the conversations we are having and debating, what's the next best product. So if you look at it from the perspective, more and more innovation will take place. And I think it is the right moment where this can actually disrupt and garner a lot of deposit together for us.
On your point, we are already at 2.7 minutes to book the FD. Hopefully, we'll get to 2 minutes very soon. My final question is on the DICGC insurance amount going up to 5 lakhs. Does that democratize FDs across banks? Should people be looking at the best rate available in the market and not be looking for a brand name of the bank to book their FDs?
See, unfortunately, a lot of people, when I talk to the customers, they have this thought that a certain bank is far more stable than the other one. But the fact is, it's only 5 lakhs. And that's something which needs to be highlighted. So although we have now started putting it in the, our FD ads and all, but I think somewhere that thought is there that no, this other bank, SBI hai, to, sorry to use these words, but SBI is a prime example. Ki SBI the government hai, right? I can put as much money, it doesn't have to worry. But in your case, I will only put 5 lakhs. So I think that part is going to be highlighted. But also I think 5 lakhs is first it was 2 lakhs, now it is 5 lakhs. I think it should go to 10, 15 or maybe 30 lakh rupees because that is the normal corpus which people have at some of the retiring age. Most of the people get 30 to 60 lakh rupees at retirement. So I think 30 lakhs is something which should happen. But of course the flexibility of holding money in 2-3 names adds to that. But still 5 lakhs is too less. But yes, it adds to the. I think a lot of investor in education has to go in to make it democratic for people to understand that 5 lakhs is a universal limit. It's not specific to a small finance or a private sector or a PSU. I think that somewhere stable money can help us to popularize.
Yeah, we already highlight that the DICGC insurance in a big way, it's stable money. Yeah. And do you think there is some engineering to be done at around DICGC? So for example, if I were to invest as a part of my family, I'd invest 5 lakhs, my wife invests 5 lakhs, and we both open a joint account and again invest 5 lakhs, therefore taking the corpus up to 15 lakhs insured instead of 10 lakhs. I don't think there is a lot of education around that.
There is no education, you're right, there is none.
Yeah.
I mean, when I get this question that, is your bank stable, that's where I start talking, otherwise I never mention.
Got it. You think DICGC is going to make a big difference in the amount of deposits that small finance banks get?
Yeah, I think maybe to begin with, especially for a bank like us where the brand awareness is not so strong, I feel initially people will test us out and saying that how the whole experience has been, how stable it is, and once the comfort is built, and you have talked about trust, right? And I'll just add another word, relationship. I think once these two gets established together, people understand that this is the bank where you can make more deposits. So maybe initially there will be a little bit of an impact for somebody placing the deposit for the first time. But as you rightly showed that 1 out of 3 customers who are placing the deposit are repeat deposit. If that being the case, I think it will be a very, very insignificant point.
Thank you. I think we've almost run out of time. Thanks a lot, Sanjay and Keshav, for this discussion.
Thank you.
Thank you so much.
Hello. Yeah. Actually, I'll like to place 3 people on the hot seat on this, and especially I follow Kalpen a lot on Twitter and his quite conservative approach, to retail investors. So coming to this DIGC insurance, right? So 80% of large cap mutual fund managers across the board have performed lower than index funds in the last 1 decade. So I'll first like to start with Kalpen is that, Kalpen, with this number in mind, with a 9% yield for a common investor who doesn't understand equity markets very well, with level playing field on taxation, what do you feel is that the ease of doing FDs can impact index funds in case it is really democratized?
See, eventually the best idea will win. And the best idea is what gives convenience, transparency, access, empowerment, and eventually the right returns to the investor. So if we go through an era of 3-4 years of mediocre returns from the market, I'm not saying we are going to go through. I have never been able to forecast. Otherwise, I would have started astrology. But there are phases when markets stagnate or they fluctuate a lot more. Generally, other asset classes do well. And in old times, what used to happen is interest rates for India were 16-17%. They were higher than, again, the ROE of corporate India. So fixed income was very attractive. And these cycles will keep coming and going. So, one thing I was reflecting when I was going through Saurav's presentation also was that, this whole thing about creating an Amazon of FDs that you're trying to do by giving transparent comparisons and, creating huge convenience is obviously something which will, and at the same time, if investor is getting sensible returns without, blowing up his money over a period of time, it will obviously be a competition. But, by the time, let me also highlight that you mentioned about large cap funds not beating benchmark. Actually, whenever something becomes a theme of discussion, in the next round, the opposite happens. In the last 12 months, 85% large cap funds have beaten Nifty by 4%. So investors are always backward looking and markets are always forward looking. Markets keep doing things which surprises us. So, that is not to say that large cap funds are better versus FDs. Both are completely uncomparable, different asset classes. If interest rates are higher and 9%, in fact, in my view, when I started my career, 8% RBI bonds were like our biggest competition. So 8% has a certain, behavioral anchor in the minds of Indians that 8% hai to acha return hai. So anything more than that will mean more money goes there. But so far the evidence that you also mentioned, 15,000 crores is coming in SIPs. So far the evidence, see, last 4 years what has happened is corrections have been very short-lived and rallies have been permanent. When I had started my career in 96, 97, 98, in those periods, corrections were long-lasting. Bear markets were long and rallies were short-lived.
Yeah, I started investing when the Sensex was 2200.
Yeah.
In 2001.
1, 2, 3. So in those days...
Till about 2004, it was less than 3,000. I remember 3 years, it was 22, 23, 20, 24, like that.
So also, all the good returns that Kirtan also spoke about last 10 years and 20 years, the starting point was 10, 11, 12 PE for equity markets. Today the starting point is 20 PE. So in a way our markets have been discovered, developed. So incrementally equity and fixed income will definitely be close friends, close competitors rather than wide gaps is how I think about it. And which is why fixed income is likely to become more valuable over the next few years.
Yeah, Anupam, I'll just kind of my 2 cents on this. And there was a lot of discussion around asset allocation and goal, right? If you can have a goal in mind. And we talked about the profile of the customer and the risk appetite of the customer. So even if I am an aggressive investor, there are goals in my life for which I am very conservative. Let's say for my child's education, if I have to save for it, I am a least conservative investor and I want a sort of a product that gives me an assurance that 3-4 years whenever he's going for a higher education, I'm going to get that money. But let's say if I have a goal, let's say to buy a luxury car, maybe at that point I'm willing to take an extra risk because even if that happens, maybe I'll go a notch below and still buy a car. So there's no standard, at least I don't believe that, a profile of an investor, if he's an aggressive, then he's aggressive for everything in his life. And there is a need to have a balance between the kind of product that we bring in on the table and the kind of product that we talked about in the previous panel. And I think there's space for both of us to coexist. And it's a good thing for investor community at large. That's my 2 cents on it.
So my thought is very similar but slightly different in the sense that There are different strokes for different people. We can't paint the the whole canvas green or blue or something. So as long as you are aware of your risk profile, you have a right allocation. That's what matters most. And people who have done that and have adjusted it according to the market, forecast for the next 2-3 years have really made money. And I can assure you that people I know, and I know them personally, people have been able to understand the risk profile, how what will happen if today my stock price, which is let's say 2,000 rupees, is gone to 400 rupees or 300 rupees. What will I do? What will be my first reaction? Would I buy more or would I panic and sell everything I have? So people who have understood that and they understood their investment horizon, I think they have made money across. People who have behaved like the cattle herd have always lost money, and that is a given fact. Somewhere contra investments are also very good thoughts to have. But again, coming back to our question, FDs will remain, and I've been telling all this while to everybody that the first thing when you start earning, buy a health policy, buy a pension policy, because PF will disappear over a period of time, and probably invest a term policy, because let's say if you buy a 1 crore cover when you are 26 or 27, at the price you will get it, you will never get it when you are 40, right? I think that's the basic things if you keep in mind. I think it really helps you to, somebody was talking about, if one medical emergency happens, your entire portfolio gets wiped out. If you have medical insurance, that takes care of it. So I think somewhere some basic thoughts have to be going right, and that's where I keep, I was talking to somebody in the education ministry also, that please introduce a basic financial management course in 11th and 12th class. We make people understand calculus, differentiation, integration. What is the use of that? Where have I used it in my life? Maybe people like engineers like you, IIT, maybe yes. But for people like us, it doesn't really make a difference if I know integration or differentiation. But if I do not know basic financial management, I'm going to blow up my money. And a lot of people do that. Thanks.
Hello. I have a question, especially since there are 3 small finance banks present in this room. With digital and democratization happening, and with the NIM advantage which SFBs enjoy, especially from microfinance side, do you think this democratization over next 5 to 7 years, in this deposit war which Sanjay mentioned, can give a lot of advantage to the SFBs in the market?
Definitely, because understand, being an SFB, you have limited money, you have limited, distribution, so you need alternate channels to build up your customer base. I think this would really help. That's what my basic 3-sentence answer is.
Yeah, so I agree. I don't look at it as a war though, Anupam. So sorry to have a disconnect on that, but yeah, I mean, with lesser distribution network, I've talked about this point earlier also. It also brings in a lot of operational efficiency and lesser cost. And I think that's going to have a very deep impact in terms of passing on those benefits back to the consumers, be it loan or deposit. See, I mean, it's very difficult for us to look at deposit in isolation. It's always in tandem with the asset that the bank has, right? So we have to always have an equilibrium between what we lend and where we raise the deposit from. So, but I think overall environment, if this supports, there's a huge opportunity to disrupt, and I think it's going to be a win-win for everybody.
Any more questions?
Yeah, you can come and catch hold of us.
Thank you very much.
So with this, we've almost come towards the end of the event. Just one last thing remaining, since we speak about gratitude so much. For the one last time, I would like to call Saurabh on stage again to deliver the vote of thanks.
Thanks, Ruchika. Long session, but couple of things we have to talk. First of all, big thank you to all our partners, Sanjay, Keshav, Vedansh, who have come here, who have also in the last couple of months taught us how the safety, compliance, and how the customer experience have to be balanced really well. Thank you so much, Kalpen, Kirtan. I know Kalpen has been always cheering for us from the sidelines. He has always messaged me I think once every month saying good work. So that keeps motivating us, Kalpen. Please keep doing that. The most important thing is to all our viewers and a lot of customers who have come here. Thank you so much, everybody, for believing in us. We are just 3 weeks old, but it doesn't look like that looking at the numbers. But we are off to a really good start just because of you guys. So I think I just want to thank you for all of that and keep showing us more love as we move forward. One important thing I want to talk, half of our team is here who didn't sleep for the last 48 hours, who are preparing for this event. Half of the team is in Bangalore who are seeing us right now, parallelly doing the customer calls, launching some of the products that we have launched. This 22-member team, I think we are, maybe I think it's safe to say, the biggest FD platform just because of these 22 people. Thank you so much for believing in Harish and me. I think it was absolutely not possible without you guys. And the most important thing, some of our angel investors, VC investors are here. You guys believed in us when we were also not very sure how we will pan these things out 10, 12 months back, right? It's a big vote of confidence. And it's because of you guys and the constant guidance over the last 10, 12 months, we have come this long and we have a long way to go. So thank you so much. Yeah, so that's all. Thank you so much for everybody who is part of this event, people who have spent time on the YouTube channel to go through Stable Money's journey, and everybody who has come here. Thank you.
I was just going to announce that please feel free to break for lunch now. Also, we have some goodies for you guys, so whenever you're exiting, please do collect them from the registration desk. And thank you once again for attending the event and taking time out from your busy schedules to be here. Thank you so much.